There is a comfortable lie we tell ourselves about the financial markets, that they are rational mechanisms. We believe that if you input data, earnings reports, interest rates, supply chain logistics, the market outputs a logical price. We treat the global economy like a calculator. But anyone who has watched a stock soar on bad news, or a currency collapse despite a strong economy, knows the unsettling truth. The market isn't a calculator. It is a crowd. And crowds do not run on logic. They run on dopamine, cortisol, and adrenaline. For decades, the holy grail of investing was information speed, getting the numbers millisecond faster than the next guy. That era is ending. The fiber optic cables are already maxed out. You can't get faster than the speed of light. So, the smart money, the true insiders, has stopped looking at the clock and started looking at the mirror. We are witnessing a quiet but profound pivot in how artificial intelligence interacts with the economy. We are moving beyond sentiment analysis, which was essentially just counting positive and negative words on social media, towards something far more invasive and predictive: subconscious market intelligence. The unfair advantage is no longer about what the market knows. It is about what the market feels but hasn't admitted yet. We are talking about AI that detects the anxiety in a CEO's voice before the bad numbers are released, or the collective digital exhaustion of a consumer base before they stop spending. This is the transition from analyzing the explicit world of text to the implicit world of human biology. To understand this shift, we have to look at the operational failure of old AI. Traditional sentiment analysis is binary and clumsy. It reads a tweet saying, "Great, another interest rate hike," and categorizes it as positive because it sees the word great. It misses sarcasm, irony, and the cultural despair behind the statement. It reads the transcript, but it misses the subtext. What has changed is the introduction of multimodal emotion AI. This technology doesn't just read, it watches and listens. In the operational landscape, this manifests in three distinct new data streams that insiders are effectively mining. First, tonal and prosodic analysis. During earnings calls, executives are media trained to say the right words. However, keeping a steady voice while hiding a revenue miss is biologically difficult. New AI engines analyze the pitch, cadence, and pause frequency of speakers. They can detect microtremors, involuntary vocal shifts associated with deception or uncertainty, that are inaudible to the human ear. The algorithm doesn't care that the CEO said outlook is strong. It cares that their vocal cords tightened by 4% when they said it. Second, micro-expression telemetry. In video formats, AI is tracking facial muscle movements that last less than a fraction of a second. A fleeting flash of fear or disgust before a composed smile is captured, logged, and cross-referenced against stock performance. Third, and perhaps most profound, is latent behavioral patterning. This moves beyond finance. AI is now correlating disparate, noisy data, like the speed at which people type search queries, the specific times of day impulse purchases happen, or the syntax changes in casual forum posts. It looks for the pre-tremors of economic behavior. It identifies the subconscious setup, the collective holding of breath, that precedes a market crash or a manic rally. The AI is not being told what to look for. It is operating as a black box, fed petabytes of human behavior and asked to find the correlations that humans are too slow, or too rational, to see. This technological leap creates a stark division between winners and losers, creating a new hierarchy of market power. The biggest losers in this shift are fundamental investors who rely solely on public data and logical models. If you are reading the balance sheet, you are reading history. If you are listening to the words spoken in an interview, you are listening to the PR strategy. By the time the facts justify a trade, the emotional AI has already positioned the insiders based on the biological reality of the participants. The rational investor becomes the liquidity for the emotional algorithm. The power shifts to funds and institutions capable of processing unstructured data. It favors those who treat the market not as a math problem, but as a biological ecosystem. The winning strategy is no longer identifying value. It is identifying conviction star. The entity that knows the market is bluffing, based on the collective cortisol levels of the participants, wins the pot. However, there is a dangerous blind spot here. As these engines come online, they risk creating self-fulfilling prophecies. If an AI predicts high anxiety in the market and short sells assets based on that prediction, the act of selling creates the volatility that justifies the anxiety. We risk entering a feedback loop where the AI doesn't just predict the mood, but actually sets the mood. We are effectively handing the thermostat of the global economy over to a machine designed to amplify human emotion. How do we orient ourselves in a world where machines have higher emotional intelligence than the humans they trade against? First, you must accept the demotion of logic. In your own analysis of the world or the markets, Understand that what makes sense is often irrelevant compared to what is being felt. Do not dismiss irrational market movements as mistakes. View them as biological signals you haven't decoded yet. Second, protect your intent. We have spent years worrying about data privacy regarding our credit card numbers and addresses. We need to pivot to worrying about intent privacy. If AI can read your micro-expressions and your typing latency, it knows you are going to sell, or buy, or panic before you have consciously made that decision. In a high-stakes environment, consistency and calmness are no longer just soft skills. They are camouflage. Finally, we must recognize that we are entering the era of the transparent mind. The barrier between the subconscious and the public record is dissolving. This technology won't stay in Wall Street hedge funds. It will move to negotiation tables, hiring processes, and political polling. The strategic takeaway is not to try and outcalculate the AI. You cannot. The strategy is to understand that the market is a mirror of the collective human psyche. If the machine is predicting fear, it is because we are transmitting it. The ultimate edge in this new era isn't having better data, it's having better self-control. The AI is reading the room. Make sure you know what signals you are sending.